3 reasons we will not have a recession. Reason number 1, you listen to all these YouTube channels and podcasts in the alternative financial media space, and you hear them talk about the inversion in the yield curve and how there's a 95% probability that if we see an inverted yield curve, how we get a recession. Well, what you people watching need to understand is this is complete disinformation. It's yield curve fake news and misinformation. And in fact, the government should be censoring it. If you ask me, that's right. But we'll start by going over this chart, going back to September of 2021, all the way to today's date. On the left, we go from negative 25 basis points up to 125 basis points. So this is the spread between the 2-year Treasury and the 10-year Treasury. And this is what all these people that are spreading disinformation on the internet are talking about. So, going back to September, we see that the delta between the 2-year and the 10-year was about 125 basis points. That means that the yield on the 10-year was 125 basis points higher, roughly, than the 2-year. And this has been going down and down and down until we get to a point where April of 2022, the yield curve inverted. I will call it maybe 3 or 4, 5 basis points. And this is when all these people in the alternative financial media space came out and started talking about a recession. Blah, 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 blah. Probabilities, probabilities, probabilities. And then, of course, they brought up this chart. Editor, go ahead and throw it up, of the spread between the 2s and the 10s, and when it inverts almost every single time going back to 1950 that the United States goes into a recession. Well, now, going back to our original chart, we can see that the inversion of the curve has gotten even more extreme to the point where recently it's been negative 20, 21, 22 basis points, meaning that the yield on the 2-year is 20 basis points plus higher than the yield on the 10-year. But what these people that are spreading this disinformation don't understand, because they're just too ignorant or stupid, who knows? They're just not listening to the Fed, really, is that this is just a self-fulfilling prophecy. And if we just go to the Fed's website, they set the record straight. Editor, cut to the internet. So this is an article from the Fed's website dated March 25th, 2022. And it's called Don't Fear the Yield Curve. So we go down to the highlighted section here, and I'm going to read straight from their website, and you're going to see that this yield curve or the inverted yield curve is nothing to fear. It doesn't necessarily mean that we're going into a recession. Here we go. To the contrary, we have provided statistical evidence indicating that the perceived omniscience of the 2-10 spread that pervades market commentary is probably spurious. That's right. In particular, our similarly titled white paper demonstrated that historically the 2 and 10 spread and its inversions would have provided no incremental information about future economic conditions if one were monitoring a very different measure of the Treasury yield curve. So, in other words, just don't pay attention to the 2s and 10s. Pay attention to something else, then you don't have to worry about the 2s and 10s. Duh. One with a much more transparent interpretation. This measure, which we named the near-term forward spread, is based entirely on yields from Treasury bonds with maturities shorter than 2 years. You see? So there you go. We shouldn't worry if the yield curve inverts at the 2-year and the 10-year, because the only thing that really matters, the PhDs at the Fed teach us this, is the maturities less than 2 years. They go on to say we subsequently expanded the analysis in an article published in the Financial Analysis Journal showing that our near-term forward spread had substantial predictive power not only on the recessions, but also for the pace of GDP growth and returns earned in the stock market over subsequent 4-quarter periods. Whereas the 2s and 10s, again, conveyed no incremental information for any of these outcomes. So there you have it. The 2s and 10s inversion is something we shouldn't worry about at all. And what they stated later in the article, and this makes a lot of sense, is that because this is such a pervasive narrative in the media, on social media, on YouTube, on podcasts and whatnot, they say that when the curve inverts, people think there's going to be a recession, therefore they spend less money, aggregate demand goes down, and they actually cause a recession. So it's a self-fulfilling prophecy. So if we could just get rid of this 2s, 10s inversion misinformation or yield curve fake news, then if the 2s and 10s inverted, we would never, ever, ever have to worry about a recession again. So the key here is to only focus on the short end of the curve, the very short end, less than 2 years. What our monetary mandarins teach us at the Fed is that this is the only thing that really has predictive powers.
George, I need you to pause right there.
Josh, can't you see that I'm doing a whiteboard video here?
You don't understand. The short end of the yield curve is already inverted.
You say what?
That's right. The 1 year is higher than the 10-year.
You're telling me the curve is inverted at 1 year?
Well, it's also the 6 month.
The curve is inverted at 6 months. And so the 6-month yield is higher than the 10-year.
That's correct.
Editor, cut to some charts. Josh doesn't know what he's talking about. Let's cut to a chart of the 6-month Treasury yield and the 10-year Treasury yield. So what we can see here is that the 6-month Treasury yield is about 20 basis points higher than the 10-year. Okay, well, editor, get rid of these charts. It doesn't really even matter that much anyway. This reason wasn't that big of a deal. So, I mean, look, the Fed was really teaching us back in March that we really shouldn't worry about this. And probably what happened was those dumb rubes in the real economy, like the people watching this video, were out there spending less money because they got worried about the 2s and 10s in the first place. And that's why the 1 year inverted. And that's why the 6-month inverted as well. So just forget this reason. The last 2 reasons are way better anyway. Reason number 2. The second reason we will not have a recession is because the Federal Reserve won't allow it. And hopefully Josh stays out of this stupid video with his pesky facts and whatnot and lets us have just an adult conversation about the reality of us not going into a recession ever again because the Fed and the central planners just won't allow it. As an example, there's a lot of this chatter in the markets and on YouTube and these podcasts about liquidity problems that we may have, and that somehow these liquidity problems that we have in the financial markets will seep through into the real economy and cause problems. But like I said, this is something that the Fed and Jerome Powell, they've figured this out, so we don't have to worry about it. As an example, the Fed has set up the standing repo facility. So just in case we have a little crack in the system, like we had in September of 2019, it won't create this domino effect that will cause a recession in the real economy. So the Fed went to the markets and said, listen, if you ever need a repo transaction, if you ever need liquidity, well, don't you worry. So we've got the Fed right here, the financial institution. So what they did, like I said, is they set up this standing repo facility. So any of these financial institutions can go ahead and give their collateral to the Fed, like a treasury, and the Fed will go ahead and give them the funny money that they need, the liquidity. You see? So we never have to worry about the repo market breaking or the interest rate spiking up to 10% again, because the Fed is backstopping the market and providing the liquidity the financial institutions need. Therefore, the real economy will never, ever be impacted again by the financial economy like we saw during the GFC. And just to prove the Fed has all the bases covered, they also have a reverse repo facility. So if the financial institutions or the financial markets, let's say, have too much liquidity, then the Fed can go ahead and soak this up by borrowing that money from the financial institutions and giving them collateral. So it's a collateralized loan. I mean, you can't beat that. So if there's not enough liquidity, the Fed's got us covered. If there's too much liquidity, they've got that handled as well. Now, it is true that the banks actually provide liquidity, commercial banks. That's kind of what they do, is they extend credit and they create dollars. We know this, especially in the Eurodollar system. So the only thing that is really constraining liquidity, or a better way to say it, is there's never really technically a liquidity shortage. There's only a shortage of confidence in counterparties, or the only shortage comes in the counterparty's ability to pay the bank back. So the banks can create as much liquidity or dollars as they want. But what really constrains them is the counterparty risk, or perceived counterparty risk. And like I said earlier, the Fed took all of the risk out of the equation. So if the markets, let's just say for a moment, I mean, this will never happen, but let's just say the markets didn't trust what the Fed was doing here, or this wasn't a panacea, well, then what we'd see is like the 1-month treasury, the yield would be trading under reverse repo. Because what this would imply is that there's a lot more counterparty risk, but there's still the same liquidity needs. And if the Fed isn't able to manage those needs, then the market would need collateral to post to get the dollars they need from the other banks extending them credit. The second thing we'd see is the repo fails, where the Fed's not the counterparty, the actual private party repo transactions. Those would spike a lot higher. Because again, this counterparty or perceived counterparty risk increases. So if I've got a deal to lend you money, then at the very last minute, I think that you're doing something shady, or that I don't trust you're going to pay me back, or maybe the collateral you're giving me isn't pristine. Maybe it's been rehypothecated 30 times instead of 3 times, which maybe I'm a little more comfortable with. Then you would see the repo fails spike. And the third thing you'd see, well, you'd see quite a few things, but the third example I'll give you is the United States dollar would spike higher against all these other currencies like the euro and the Japanese yen. This would imply that there's a shortage of dollars out there, or again, better stated, that there's a shortage in confidence of counterparties, so the banks aren't willing to provide this liquidity. But we would only see these things happen if the market participants didn't have full faith and confidence in the clever, very clever solutions that the central planners in the Fed has come up with. And obviously, we're not seeing any of these things transpire in the market. So again, absolutely nothing to worry about.
George, I'm sorry, but I'm going to have to interrupt again.
Josh, you got to be kidding me right now. Again, you're going to interrupt this whiteboard I'm doing right now. What is so important that you need to interrupt me?
Well, we are currently seeing every single time that the Fed has raised rates recently, the 1-month T-bill has gone below reverse repo. We have also seen repo fails spike even past where they were at the height of the cerveza sickness. The last thing is the DXY that is surpassed 109 and is still remaining extremely elevated.
So wait a minute here. You're telling me that every time the Fed has hiked rates lately, the 1 month is trading a lot lower as far as the yield than reverse repo. And you're telling me that the repo fails have spiked higher and the USD, that the DXY is at what, 106, 107? And it got up to 109 the other day? No, this can't be possible. Editor, go ahead and throw up the yields. Let's say just going back to the end of June on the 1 month Treasury and reverse repo. It was trading a lot lower. Okay, fine. Just pull up a chart of the repo fails. Let's see if that's spiked lately. Okay, it has. Okay, we'll just forget those. Let's go to the US dollar. I mean, that's what's most important. Obviously, the dollar wouldn't be even close to 106 or 107. It wouldn't have spiked higher over the last few months because obviously the market participants are smart enough to know that the Fed is going to provide all the liquidity the market needs. What you're telling me, that actually got up to 109. This is unbelievable. Okay, fine. Listen, reason 1 and 2, they really don't matter at the end of the day. Just ignore this. Forget that part of the video. What's really important is what we're going to discuss throughout the rest of this video. Reason number 3, we will not have a recession. And boy, oh boy, I have saved the best for last. That is right. Hopefully Josh won't interrupt anymore by giving me all of these quote unquote facts. He needs to understand that I don't pay him to give me facts. I pay him to give me facts that fit my narrative, for heaven's sakes. But anyway, getting back to the whiteboard video here. The top reason we will not have a recession is because the White House and the mainstream media is helping to educate us, or maybe re-educate us, on what a recession actually is. If we just listen to the experts like Janet Yellen, Jim Cramer, and Paul Krugman, and we just continue to consume far more than we produce, then we never ever have to worry about an economic downturn. Editor, go ahead and cut to the internet. Okay, let's start by going to the most trusted source of information we have, the White House. And this is a blog post from July 21st, 2022. How do economists determine whether the economy is in a recession? And thank goodness they came out with this blog post right before they're going to announce second quarter GDP on Thursday. I mean, the timing is absolutely perfect on this because, let's just assume for a moment, I mean, it's not going to happen, but let's just assume for a moment on Thursday, they announced that we had 2 consecutive quarters of negative GDP. Well, a lot of people would claim that's a recession, but thank goodness we've got the White House educating us that really when the economy is contracting, that's not really a recession at all. So let me go ahead and read what they're saying here. They say, what is a recession? While some maintain that 2 consecutive quarters of falling real GDP constitute a recession, and when they say some people, they're referring to Google. I mean, if you just Google it as an example, the first thing that comes up for the definition of a recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. So going back to the blog post from the White House, you can see why it's so helpful for them to come out and educate us or re-educate us on what a recession is truly about. So going back to their post, they say, that is neither the official definition, although it's on Google, nor the way economists evaluate the state of the business cycle. Instead, both official determinations of recessions and economists' assessment of economic activity are based on a much more holistic look at the data, including the labor market, consumer business spending, industrial production, and incomes. Based on these data, it is very unlikely that the decline in GDP over the first quarter of this year, even if it's followed up by another decline in GDP in the second quarter, indicates that we're actually in a recession. So you see, guys, I mean, obviously, most of us in the real economy are just too stupid to understand these very, very complex dynamics that are at play here. But thank goodness we've got the administration out there helping us to understand these details. So if you're losing your job, or if your standard of living is going down, or if more and more people are unemployed, or if economic activity is contracting, or if economic output is declining, or who knows, maybe if we even see 10 consecutive quarters of negative GDP growth in real terms, that doesn't matter. What really matters is if the central planners say we're in a recession. That's what we should really be focused on. And on that note, let's go right over to this article from the Washington Post. And they referenced this incredibly awesome blog post from the White House. Last week, the White House issued a document stating that 2 straight quarters of negative GDP is neither the official definition nor the way economists, serious economists, evaluate the state of the business cycle. Treasury Secretary Janet Yellen, in fact, on Sunday, went so far as to say she would be amazed if the National Bureau of Economic Research, which determines whether we are officially in a recession, were to declare that we're actually in one. She also stated flatly that we are not in a recession. And Paul Krugman backs this up in the New York Times. Krugman states, looking ahead, the economy is currently cooling off. Okay, we can admit that much. The decline in the first quarter GDP, it was probably just a quirk, but overall growth seems to be running a little below trend. So you see, guys, we're still growing as an economy, just maybe a little under trend, but nothing to worry about. Just keep on spending, keep on consuming more than you produce. And it's not just the intellectual giants like Janet Yellen and Paul Krugman. It's people like Jim Cramer from the trusted CNBC. He says, I may be the only person besides Jay Powell who believes we are not going to have a recession. And if you can't trust Jim Cramer, I mean, who are you going to trust? Talk about someone that is highly, highly accurate when it comes to his predictive abilities here. But the main point is that there's a lot of misinformation and disinformation out there, just like we said at the beginning of the video. And we really need the government to come in and censor all of these inaccuracies, because if they don't, then we're going to be left to make our own decision, and that's incredibly, incredibly dangerous.
George, I'm sorry, but I'm here again.
Josh, what are you doing? You're following me here as well? What is so important that you have to interrupt me once again?
Well, George, I think that you're missing the main point, that it is actually these governments that are making these false statements. Let's go back to the cerveza sickness. We have all of these government experts that are first telling you that masks are useless and no one needs them, and then everyone needs a mask. We saw the same type of lies about effectiveness lockdowns would come, and then the efficiency of the jab and the mandates that followed it. We've seen the exact same type of lying and misleading on the CPI for years. Now, the same thing that's happening with these sanctions of Russia. Everything that we're told, almost the opposite is happening. These exact same government experts that have been wildly wrong and lied to us about everything are now trying to change the definition of a recession. So if they've lied to us all throughout the past, why would this time be different?
Oh, okay. Wait a minute, Josh. Let me get this straight. So what you're saying is that when it comes to our health, or even in economics, the government that is actually out there trying to protect us by censoring misinformation and disinformation are the biggest spreaders of misinformation? Okay, guys, we're back to normal. What we tried to do in this video is we tried to take a lighthearted approach to a very, very serious topic. I wanted to inform you of what was going on with some of the data. I wanted to try to educate you on how things work in markets. But most of all, I wanted to give you a warning. What I have noticed, especially since 2020, is whenever there are facts that come out that are counter to a specific narrative the central planners or the authoritarians are trying to push, they attack these facts or they try to explain them away. And they use the quote-unquote experts and the mainstream media to do this. It's gaslighting like I have never seen in my life. They're using straight propaganda. They're not trying to help you. They're simply trying to manipulate you. So moving forward, I want to try to encourage you to do the opposite of what they are telling you to do. Do your own research. Think critically for yourself. And always be very suspicious of what they are telling you. Understand that 9 out of 10 times what they deemed to be dangerous malinformation turned out to be true. In fact, what my good friend Chris Martenson always says is that truth is simply 6-month-old misinformation. So moving forward, whenever they give something that label, whenever they try to censor something, be very, very suspicious. Do your own research and always, like we said earlier, think critically. There's one thing that they can never, ever, ever take away from you. It's right here. Your mind and your ability to think for yourself. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.